Happy Friday, everyone, and welcome back to Your Finance TV. As you know, every Friday, we are lucky enough to spend some time with Jay Pelosky and to go through his musings. And this time, it's his monthly musings. How are you, Jay?
Scott, I'm happy to say happy Cinco de Mayo to you, and hopefully you're going to celebrate as much as I plan to celebrate in a couple hours.
Sounds like a great plan, but we're going to do a lot of work before we get to there. We're going to jump through your musings. We're going to use that title forward, which I love. Let's get into it. What's the first step we want to start with these musings?
Yeah, no, I mean, it is the title. The title is very basic this time, forward. And basically, it just struck me that with the weather here in the New York area being, way below normal temperatures, the calendar says May, right? Cinco de Mayo says May, but the weather feels like March. And I think it's similar in the halls of the Fed, right? The Fed has been engaged in the most aggressive rate tightening cycle in 50 years, and yet inflation remains above target. And then you have the recession calls that have been going on for well over a year and still no recession. So time is passing, but it seems like we've not made really much headway. And that led me to the idea of just simply titling this monthly Forward, because we believe that we are moving forward. We continue to think that a big move is coming, that the S&P is going to break out of its long trading range, which we've talked about over the last couple of weeks, will break up and out, so not break down. And we think that this time is different, that the cycle is faster, that things are sped up. And I know we haven't even really fully integrated AI, but things are moving at a faster pace. And so while many, particularly the folks in the recession/bear camp, think we're late cycle going into a recession, we take an opposite view and think that we're early cycle and on the early stages of a global economic recovery, led primarily by Asia, but also including Europe. And we think the U.S. economy is also going to pick up as we move through the course of this year. So there are some concerns. I mean, the principal one would be the continued weakness in U.S. regional banks, right? We wrote a piece back when SVB failed. We wrote Firebreak, where we argued that actually this is a good thing in a sense that it forestalls the Fed from moving more aggressively and really over tightening and damaging the real economy. But if we're wrong about that, right, if the regional bank woes continue to weigh, and if there really does become a credit crunch, which we think is still unlikely, but if it does materialize, then our no recession call is probably going to be wrong. And so we're watching that XLF, the big bank ETF, as a key signal for us. And that $30 to $31 level is really an important level for that instrument to maintain. And then I just finish up by noting the great macro investor Stan Druckenmiller came out recently in an interview and said that the current investing environment is the most uncertain he's ever seen in his 40-plus year career. And so to us, that just reminds us that we want to be open-minded, that we want to really focus on the weight of the evidence, and we want to have a wide funnel as we search for that evidence. And so we provided in this monthly 25 charts and tables from well over a dozen different research providers to give us that weight of evidence and help us on the journey to what we think is a new bull market. We see earnings coming in better than expected, not just we, but everyone does. They are coming in better than expected. Analysts are raising their forward estimates. Company guidance, according to Bank of America, is the best it's been in years in terms of companies guiding higher. The global economic data continues to point to growth. The US dollar continues to weaken, and we believe inflation is going to continue to decline in the months ahead. And so to us, we continue to think that there's a lot of opportunity in the global cross-asset markets, and we remain fully invested in our global multi-asset model portfolio.
Thanks for that, Jay. Now, I think the beauty about your monthly review is you break it down in those 5 sectors afterwards: climate, economics, politics, policy, and markets. It's a great way to look back on the market over the last month. Talk to us about the climate side of it, because I feel like the climate side at the moment, a lot of people have like pushed it to the background a little bit. It's just because they've been panicked about the markets, worried about the markets. What are you seeing on that side?
Yeah, no, that's a great point, Scott, and a great question. I mean, just as a reminder to the audience, these 5 segments, climate, economics, politics, policy, and markets, are not just chosen randomly, right? They make up what we call our global risk nexus. And what it does is it allows us to focus on these key areas across each of the 3 main regions: Asia, Europe, and the Americas, that make up our tripolar world. And that tripolar world is our framework for trying to understand the global economy. And we've said it before on Your Finance TV, but it doesn't hurt to say it again. If you're going to do global macro investing, you have to have a framework. You have to have a process. Otherwise, you're just going to get swamped by all the information, or you're going to get distracted by something going on, a dumpster fire over here, or a good up move in a different market over there. So the global risk nexus is something that we've employed now going back to, I believe, 2018, I think is when we launched it. So 5 years. And so it's a, tried and true tested process for us. And so with that being said, climate, it is interesting. And your point, I think, is spot on. I mean, it's actually been quite frustrating to have a lot of climate exposure. And we have a fair bit, both in our global multi-asset model and especially in our TPW 20 thematic model, which is almost 35 to 40% climate investment focused. And what I think has happened is, as you pointed out, there's a lot of concern, what we call the curtain of FUD, right? Fear, uncertainty, and doubt. And that's really obscuring all that's taking place, kind of quote unquote behind the scenes in the climate space. And so we think as that curtain of FUD gets pulled aside, and remember we had a piece out a couple of weeks ago saying, look behind the curtain, talking about exactly this issue. We think climate will reveal itself to be an alpha generator, in large part because its scope and scale is unparalleled, right? It's global. The amount of money being spent is significant. We talk in this monthly about the climate side of the Inflation Reduction Act, and note that just in the 8 months since that act was signed, 45 billion or so of new projects have been identified, have been announced. The US companies make up only less than 40% of that 45 billion. So 20 billion in investments coming from abroad, as companies realize if they want to sell in electric vehicles and batteries in the United States, they need to locate production in the Americas, not just in the United States. Importantly, the climate process is a way to really, and we see it, it's really starting to reshape the speed and pace of the regional integration that we think makes up the tripolar world. And so one of the ways we've been playing that, so an investor may say, well, what does that mean? So you own, uranium, or you own electric vehicles. Well, you also can own, and we do, Mexico, because Mexico, we think, is the single biggest global winner of the realignment of supply chains, particularly around semiconductors and electric vehicles. And so no surprise that Mexican exports are at a record. No surprise that growth in the first quarter in Mexico was up 4% year over year, significantly better than the United States. And also no surprise that Mexico has broken out and is moving towards all-time highs, while the currency is one of the strongest currencies in the world. So this is how you kind of tie together things like climate to not only specific climate focused investments, but also how we tie it together to our tripolar world thinking and trying to integrate opportunities within each regions. And Mexico right now really is a poster child for how this is working in the Americas.
Okay, so let's move on to the next part that you break down is economics. Now, obviously, a ton of economic data coming through at the moment. I thought we would have had a little bit of volatility in the back of it, but it doesn't really seem to have happened. Run me through what's been like the highlights on the economic side.
Yeah, you again hit the nail on the head. There's so much stuff to talk about. You could write, tons of articles and tons of pages just on the economic data. But we want to try and cut through that data and assess what it means going forward. Again, to the point of the title of this monthly, forward. And so what we're focused on at TPW Advisory are two areas that have been big drags on the US economy in particular, and that's housing and inventories, right? Two big drags on the US economy over the last year. We believe that both have bottomed and are going to be additive to US growth as we move through the rest of this year. And I'll give you just an example. There's a lot of talk about the ISM manufacturing survey being, under 50, 50 and above is expansion, below 50 is contraction. It's been below 50 for 26 months already, over 2 years. And importantly, that contrasts with the average length of a ISM manufacturing report under 50 of only 17 months. So this is already the manufacturing slowdown. The point is that the manufacturing slowdown is already very long in the tooth. And we've had this huge inventory destocking, right? Because companies, first they generated all that inventory when they were worried about supply chains and COVID, et cetera. Then they worked down that inventory over the last couple of quarters and expecting weak growth in 2023, haven't really restocked. So we think importantly that the restocking is about to start to occur. New orders are starting to pick up, and that is going to bring the manufacturing sector back. And so inventories are going to be a source of growth, the restocking, not a detraction from growth. And on the housing side, we would just note that the supply of existing homes is less than 3 months. Now, typically, the average supply of existing homes on the market is 6 months. So we're 50% below the average. And what that means is that if you want a house, the only way to get one is to buy a new build. And that's one reason why home builders are breaking out to new all-time highs. So while you can be distracted by the headlines saying, housing crash and mortgage rates skyrocketing, blah, 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 housing stocks are at new all-time highs. And we know because we own XHB, which is the home builder ETF. And so this is what we're talking about in terms of this dichotomy. But importantly, two big factors which have been drags for the US economy, housing and inventories, we expect to be providing growth as we go through the rest of the year. Main reason why we don't expect a recession in the United States. Very quickly onto the rest of the world, because we do like the rest of the world. We are overweight non-US equities. The same is holding true in Europe, right? Europe has record low unemployment. April unemployment was a record low. They have an April PMI composite reading of 54, the best in roughly a year. The euro is cheap, and energy prices are below where they were before Russia invaded the Ukraine. So we see Europe as also being poised for growth. China remains the global growth locomotive. People are knocking the fact that their April manufacturing PMI came below 50 for the first time in months. But we're focused on domestic demand, and domestic demand is doing very well. Their composite PMI was, again, over 54. And you have a huge focus on property, which is something we've paid attention to, and property prices property sales, house sales in China have been up 3 months in a row. So we see the turn happening in China, and that leads us to continue to think Asia is the locomotive. And by the way, Japan, we think is exiting deflation and going to move off of yield curve control. That's going to help the currency strengthen, the yen strengthen, reinforce dollar weakness, which is one of our key themes. So again, when we look around the world, we see the U.S. economy starting to pick up speed, housing and inventory going to be positives, Europe poised for growth, China in growth, Japan exiting deflation. Those are positives to us, not negatives.
Okay, well, let's move on to the politics front then, because listen, there wasn't really that much in the politics front come out this month, was there?
No, actually, you're right. We can get through politics more quickly than the last couple. First off, President Biden is going to run for re-election. No real surprise. Early polls show him beating former President Trump and potential Republican challenger, Florida Governor Ron DeSantis. Polls show him beating both. But what we focused on was an important speech given last week by the National Security Advisor, Jake Sullivan, laying out kind of how the U.S. thinks about this new world of kind of competition with China, this issue of tech stacks and security, the issues of climate mitigation. And here's the takeaway quote, or at least takeaway for us. The National Security Advisor to President Biden said, it is a time to build at home and abroad. This will require a major reorientation of both domestic and foreign policy. And that plays right into one of our main themes, right? Which again, we've talked about before. We think we're in a significant policy shift across a number of fronts. You know, central banks moving from a 2% target to accepting a slightly higher target. Return of industrial policy to the US. That's what Jake Sullivan is talking about here. Industrial policy back in the US. First time in 70 years. Global capex boom to deal with COVID, climate, and conflict. So these are the changes that we see taking place, and we think investors are missing because of this curtain of FUD. And we want to pull aside that curtain of FUD and recognize that the world, as it's moving forward, is looking different than the world of the last decade or so.
Every time you say FUD, I think of fudge, but that's a discussion for another day. All right, let's move on to policy. Now, there's just so much happening on this front. Every country in the world. We're like, listen, obviously you've had the Fed rate decision this week, and a lot of noise on that, a lot of press on it. But like, it's not just the US, right? Like, as you said, you cover the whole world. What have you got to say on policy?
Yeah, no, we are global macro investors, have been for decades, proud of it, and think there's a real opportunity set for the global investor after a decade where it was really just the US was the only game in town. So important point. Yeah, we'll start with the Fed. We did not find Chair Powell's presser to be as hawkish as the market took it. We kind of think the fixed income investment community is really kind of just recycling the same script, the same movie. The Fed raises, then they stop, then they cut. And because we're going to have a recession because the Fed breaks something, we don't see any of that playing out, right? We thought the chair's comments were perfectly appropriate because we don't expect a recession for the reasons we just talked about. We don't expect rate cuts. And therefore, we don't see it as hawkish that the Fed is going on hold. We think the hold is going to be extended. And we would note that the average holding period at the terminal rate is roughly 7 months. And that suggests a cut, you know, we're in month 5, 4, so it suggests a cut by the end of the year, not July, as the bond market is thinking. And so we think the bond market has it wrong, is replaying old scripts, not recognizing that this time is different, not recognizing the sped up nature of the cycle. And the other thing that we have to talk about is obviously the jobs number today. 235,000 versus a forecast of like 185,000. So stronger number than expected, but offset by March's jobs number being revised down significantly from right about the same 235 to 165 or so, suggesting to us that we have a stable jobs market that's cooling. And we think a cooling jobs market is perfectly fine. We just don't want to see a collapsing jobs market. And we don't think we will. In Europe, same type of deal. ECB raised rates. They have stepped down from 50 basis points to 25, much as the Fed went from 75 to 50 to 25. ECB at 25. Probably going to raise a couple more times because inflation is running at about a 6% pace in Europe, higher than in the US. And therefore, we think that is another reason why we see dollar weakness as we move forward, as the Fed goes on hold, dollar weakness, because the ECB is going to continue to raise rates. Japan's going to move off yield curve control, etc. The only other point we would mention is that China rebound continues to play out, as we touched on earlier in the economics section. You know, massive records broken this weekend in the May Day travels, up 100% year on year, up 20% versus 2019. So, you know, the main locomotive in the global economy, the second biggest economy in the world, China, likely to grow at 6% or more this year, and that domestic demand really starting to come through. And we think that's really positive for global economic growth in the year ahead.
All right, well then let's wrap it up with markets. And obviously this month earnings have started up again, a lot in the US. We're starting to see them come out of Europe as well. How is, like, when you wrap up all of this, and obviously that's why we finished on markets, how is it all looking?
Yeah, no, that is exactly right. Again, the whole point of our process with the Global Risk Nexus is to go through the main points, the climate, which we see as the single biggest global macro theme, economics, politics, policy, and we think economics and politics lead to policy, right? Then you wrap all of that together. What does it mean for the markets? Exactly right. So look, I mean, our view is that earnings are coming in better than expected, that estimates are being raised, right? We talked a couple of weeks ago about the contest between earnings or sell-side analysts raising their earnings targets for the second half of 2023 versus fixed income investors who are pricing in a recession and multiple rate cuts over the same second half of 2023. Both can't be right. And it looks to us increasingly, and we side on the analyst side, increasingly that looks like it's playing out. Because as we touched on, estimates are being revised up, earnings are coming better than expected, forward estimates being revised up, not just in the US, but also in Europe, importantly, and in Japan. Earnings growth in Japan in Q1 is running at about 15% better year on year. In the US and Europe, we're just kind of happy that earnings are coming in roughly flat year over year. So there's real earnings growth happening outside the country. And companies are raising their guidance. And so we think the time frame for the bearish argument to play out, which is that imminent recession leading to sharply lower earnings, which takes down the US economy, we think the time is really running out for that thesis to play out. And that's one of the reasons why we think we're going to break out and up, because we're at 4130 or something today. We get above 4,200, which the market has a hard time breaking through, but we think we're going to break through that as it becomes clear that the economy is not going into recession. Then you get to 4,300, which would be the mark of a new bull market, 20% up from the low of October. And that brings in all the money that's gone to cash, all the bearish investors, all the people, like the JP Morgan survey, one of the charts we have in the monthly, shows that I think half of 1% of JP Morgan's investor survey, institutional investor survey, thought the S&P would end the year above 4,500. Half of 1%. So that tells you where the institutional mindset is, right? And
Yeah.
so in our view, we have traversed beyond COVID. We are now moving beyond COVID's kind of inflation spike. And what comes next, in our view, is not a return to the 2010-2020 period of low nominal growth and low inflation, but rather a period of high nominal growth, slightly higher inflation, blessed by the central banks, and driven by this need to mitigate climate, deal with tech dispersion, and prevent conflict. And so for us, we remain fully invested, overweight non-US equity, both DM and EM. We remain sharply underweight fixed income. Don't see any attraction at all with a 10-year treasury yielding 3.3%. Don't see any attraction with cash. Cash has been one of the worst performing assets. Another chart we have showing cross-asset performance year to date through April. Cash is one of the worst performing assets year to date, one of the worst, yet everybody seems to want it. Makes absolutely no sense to us. We continue to be overweight commodities, especially gold miners, which is a play on the idea that slightly higher inflation is going to be a feature, not a bug of the coming years. So we love GDX, gold miners. We're also long energy and industrial metals. And that does give us a little pause because they haven't been acting well. And we're trying to figure that out. That's one of the things that, keeps us a little bit nervous, is that commodities really haven't acted particularly well. But again, we think a lot of that is that curtain of FUD. And as it becomes clear and that curtain gets pulled aside, we think, oil at $73 and Brent, or copper down where it is, will be seen as being pretty attractive for a global economy that's on an early cycle of economic growth, not a late cycle going into recession. So that's how we see it all playing out.
That's great. Jay, thank you so much for this. We obviously do a lot of work in the background with images and so forth. I have to come up with some sort of an image for FUD. I don't know what it's going to be. It might take me a bit longer than usual for this one, that's for sure.
All right. Well, we want to keep you on your toes there, Scott. TPW Advisory is not just any, run of the mill. We come up with some interesting, different stuff. We like challenging our clients. We like challenging our peers. And so there's your challenge for today. I can't wait to see what you come up with.
All right. For everyone who's watching, don't forget you can go to Pelosky.com to sign up for these musings and learn a lot more about Jay and TPW Advisory. Jay, you have a great weekend.
Same to you, Scott. Thank you.
And for everyone else out there watching, good luck investing.